It's a new year and it's game on, not just in New Hampshire, but also in the S&P 500, hanging out right around 200-day moving average. Its significance for those folks who care about charts and for anyone else who wants to make money. Parets is here. He's from allstarcharts.com. He's going to tell us what's going on. My man, S&P 500. Everyone's making their kind of, predictions for the end of the year. We made fun of them yesterday around here because they're sort of pointless. Let's talk about the near-term levels that matter on the S&P 500.
I think that the 1260 level, which was the March lows, also the June lows, the beginning of August when that broke, that breakdown turned out to be devastating for U.S. equities. We've been trying to get back above that 1260 level the entire fall. Continue to test it, continue to fail at that level. And just recently, we're starting to see some penetration of those levels. So I think that 1260, now that we're back above it, is really the area that we want to watch.
And how many times does this have to act as support? It's prior resistance equals support, as you know. Do we have to get down to 1260 and prove that resistance a few times? Because we've had a few fake breakdowns and breakouts on that spider side.
Yeah, it's something that we need to be used to. That's the world that we live in. Do we need to retest that 1260 level? It's really difficult to say because it's more of a range than anything else, which makes our lives even more difficult. It's not, we break above 1260, we hit 1261, clear skies. It doesn't work that way. So, we just want to see the S&P 500 stay above 1260. We have a downtrend line from the June highs that were tested 5-6 times, failed every time. We recently got above that. That area also represents the 200-day moving average, which is very, very important. So as long as we can remain above that level, I think the path of least resistance is higher, but be careful for, moves below that.
The trade that worked last year, for the most part, was shorting against that 1260 or selling it, and then getting down to 1200. The range has been tightening up a little bit as people have been playing it harder and harder. But the area from 1250-ish to 1200 has been sort of the range that plays. Do the odds favor going back into that? The path of least resistance may be higher, but if we get a 1250 close, 1245 close, for the active trader, should they be starting to pare back a little exposure at that level?
The risk is lower. With all of this indecision, I think that we definitely want to err on the side of caution. When you're not 100% sure, you don't have a lot of conviction, which is pretty much where we're at right now, trade smaller. You don't have to be all in at all times. Cash is good too. But we definitely want to keep a close eye on that 1260 level. And more importantly, as far as the components of the S&P 500, we want to see some sector rotation. In the second half of last year, when you said that was the range, 1200, 1250, who are the leaders? Utilities, healthcare, staples. That's not what we want to see. We want to see breakouts in energy. We want to see basic materials breaking out. Consumer discretionaries have shown strength all through last year.
Right on. Consumer, baby. USA.
Right?
Yeah, absolutely. Absolutely. Sure you.
So that is one area that is a positive, but we want to see energy, basic materials, industrials. We want to see leadership in those areas.
Industrials, energy, basic materials, it's, I'm nodding off. You're making me a little narcoleptic. But those areas, just the nuts and bolts of the economic growth cycle, if those are taken off, that's going to give us both technically and what it suggests fundamentally strength for the market.
We need it. The market's not going to make new highs with leadership out of defensive names like staples and utilities. And just yesterday, with the Dow up 200 pretty much all day, utilities were down. Staples underperforming, healthcare underperforming. We want to see more of that. We want to see leadership out of the risk-on names, right?
Risk on. It beats risk off. Targets for the upside. We got this 1260 thing on our downside. That's going to be now our support. Where are we going on the upside? 1350 was everyone's prediction for the end of the year. That's last year's high-ish area.
Yeah.
If we break out here, is that the next target, or are we looking lower?
And that's where the indecision is, and that's where the lack of conviction is. If we're right, 1260 holds and we rally higher, we see what, 6%, another 7%? Is that going to, make your year? Probably not. So there's not that much more upside potential in the S&P 500. Sure. 1350, 1360, I would be peeling off at those levels.
Better than a poke in the eye with a big sharp stick.
Agreed.
Or for that matter, living through 2011 again.
That's right.
Parets, folks, he says, watch that 1260. We hold that. It's a little upside rally for you. Not going to make your year or send your kid to college, but it beats stuffing envelopes or tying lug nuts on. Thanks so much for joining us.
Thanks, Jeff.